Welcome to TheoTrade. This is Don Kaufman. It's July 2nd, 2016, doing the weekend update here on our 4th of July weekend. This evening I'm going to start in a bit of a more unlikely place. So rather than rehash everything we've had with the British exit, which of course now has been named. If you haven't heard this, you're probably hiding under a rock somewhere, but of course we're calling it the Brexit, and then followed by none other than what I'll call the brally, which is like a British exit rally. Quite hideous this past week, but again in an unlikely place that I kind of kicked things off this evening. What you're looking at over here is a 10-year monthly. So again, I don't want to rehash the obvious, and coming into this next week, well, we're coming into a shortened kind of holiday week. We might see a little bit of lower volume. Nevertheless, we could see some heavy activity. Still quite a bit of volatility even coming into Thursday and Friday of this holiday weekend. Nevertheless, I start with a 10-year monthly, and as you guys may or may not know, if you've watched a bit about TheoTrade and myself from time to time, I like to kind of zoom out and look at some comparisons. So here we go to kind of kick off the comparison, and I'll explain it a bit more detail of what we're looking at here this evening. First and foremost, again, this is the three-line comparison. Right over here, we'll start on top. What is this? This is none other than gold. Okay, coming in inside the middle here, almost in a dead heat. Number 2 over there is the SPX, or better known as the S&P 500. So we've got our S&P 500, and last but definitely not least, happens to be none other than the bonds. Which ones, you ask? They're the 30 years. Okay, so our primary is the ZB. It is a futures contract, but it's a 30-year bonds. We compare it to the S&P 500, compared, of course, to gold. Do you think a look to this? Okay, and how many people have actually looked at this on a 10-year monthly? Gotta zoom out, stare at it for a moment, let it kind of sink in. So gold, which again, I haven't been that much of a gold bug in many years. It's been since about 2008 since I've really probably thought a lot about gold, talked a lot about gold, and we looked at gold a tremendous amount in 2008, only because, listen, I was in the brokerage industry. It's the end of the world in 2008, and everybody was buying gold over there. The irony of that is everybody didn't really buy gold in 2008, and it shot up, obviously, 2010, 11, 12, peaked out. But on 10 years, okay, if you look at three major asset classes, people think of the S&P 500 or the stock market, and think of the bond market. Why not throw one of the commodity products in there, which is gold? Because gold's actually outperformed the other two asset classes. Now, strange things are occurring right now when you have the S&Ps, which, again, I'm highlighting right now the S&Ps and the bonds over the last 10 years. Where are they? Their performance, if you just bought the bonds, which, again, have, a yield associated with them, an interest rate associated with them, the bonds versus the S&Ps, and the S&Ps, of course, do have some yield with them as well, because there's dividends in there. Nevertheless, it'd be pretty much a dead heat. In fact, if you zoom in, you kind of hand it to over the last 10 years, you kind of got to hand it to the bonds. They've not only kept up, but again, they're at all-time highs right now. So over 10 years, you got three major asset classes, and the bonds and the S&Ps are a dead heat. Gold outperforms by far and away. Now, why am I bringing this up? Well, first of all, to state the obvious here, I'm starting to think that this whole FOMC interest rate thing, I'm thinking it's causing a couple of problems. A little bit of sarcasm in there. Nevertheless, you're getting bonds moving, okay, with and in correlation with the S&P. Now, over the last 10 years, it doesn't look like that much, but here's where things start to get interesting. The exact same correlation, okay? Again, correlation, comparison. What I'm showing you is really a comparison. But in the exact same comparison here, once again, we have three major asset classes. Okay, take a look at them compared over 1 year. Again, the comparison is vastly different. So let's label them again so everybody's kind of aware of what we're looking at, because, really on this holiday weekend, kind of relax, forget about the markets a little bit, but this is some, food to kind of think about. Here's the SPX, the underperformer. Then we come into what? Gold. Okay, the top performer over here, bonds. The one thing that really stands out to me in this particular circumstance, and you're looking over the last year, is sure, we see this absolute rip and rally Tuesday, Wednesday, Thursday, Friday of this week, and I am the first to tell you, I'm still short. I'm on the wrong side of the SPX rally. Okay, and I happen to be short bonds on top of it. Oh, the pain, the agony. It's been all right. Okay, I'm still collecting a lot of premium against those for those of you that sell options. Okay, I'm selling options. And with all due respect, I've been short the S&Ps now for a whole long time. What have they done over the last year? Well, they moved up about 1%. I've sold a lot more premium, okay, than they've moved against me. 1 week is not going to change my mind on the SPX. But really, when I say, a little bit of food for thought over the holiday weekend here, so these two asset classes, historically speaking, have been used for protection, okay, against either an ill-performing S&P or just risk in the world out there. And I say risk in the world. The bonds have been known to rally massively during periods of recessions, okay? Gold has been known to be a rip-roaring rally during periods of extreme volatility in the S&Ps, and yet we still have the S&Ps that haven't done anything inside of the last year. I don't know how many people are looking at this, but again, this is exactly 1 year. It's not a year to date or anything like that, but it's exactly 1 year. The S&Ps haven't moved. Gold's up 15%. The bonds are up 21%. And on top of the fact that they do pay an interest rate, but what's the interest rate on those things now? Oh, it's like, just over 2%. It's not too exciting on a 30-year. Nevertheless, okay, the way that I interpret this, and the only way that I can interpret this, risk is still absolutely, without unequivocation, on the table. Even if you want to make the argument that the whole world right now is dumping money into U.S. treasuries. That's the bond market, right? The treasury market, the debt market. They're doing it because you look at places like Japan, they got negative yield. All right, Germany, negative yield. All over Europe, negative yield. That ain't getting any better with the Brexit. All right, gold takes off to the upside. Now, what's disconcerting in gold is strongly influenced by the dollar. But I was curious. So before really putting this together, I took a look at the dollar at the exact same time, and again, I can do that. So why not? We've got enough stuff added to the chart. Just add something more. When I first started trading, it was an individual worked with me. He always said, if you put enough lines on the chart, the stock will hit it. But I wanted to look at the dollar over the last year too, and I wanted to see, does the dollar, okay, and here it is, the dollar down below, but does that dollar, is it having a drastic influence on possibly gold? Gold's a commodity, so very often if the dollar were to sell off big, gold might explode higher. The irony, what is the dollar doing over the last year? Absolutely nothing. And everybody's talking about currencies and so forth. Okay, currencies right now, kind of, bow out a little bit because it's such a heavily influenced, I say influenced. What's the right word for what currencies are? Oh, manipulated. All right. I mean, Japan comes out there and they're like, we are going to sell our yen, not because we want to devalue our currency, but because it's the right thing to do. And Japan, is doing it. China's all over it, but China doesn't do it quite as obviously. They call it pegging, all right? The peg is just getting a little bit lower. Nevertheless, if you look at the U.S. dollar, and this is the U.S. dollar futures, which is the dollar against 6 other major currencies out there, it's actually flat. So any way you want to look at it, the S&Ps are relatively flat, the dollar is flat. The world is buying gold, the world is buying bonds right now. And again, I recognize that the rest of the world wants to buy the treasury market out there, and the treasury market, is taking off. Gold, let's say even gold's got to be influenced to a degree by all these different ETFs like GLD and so forth. Nevertheless, the moves in gold in the bonds, I should say, are extraordinary right now to the upside. In fact, even tighter time frames. We'll go into a 6-month kind of comparison over here. And 6 month, they're all actually moving, all right, in, again, almost like relative tandem inside of the last few days. But an even tighter angle over here is, we'll take it all the way down again to a 1 month daily in this comparison here. And this is where I caution you. And again, I want to get rid of the dollar, because what has the dollar done in the last month? Relatively speaking, nothing. It's been up, it's been down, it was volatile. But I'm actually going to remove the dollar from this equation over here just to make it a little easier to interpret. Make no two ways about it. And what I am, in my kind of logic over here, and again, here are the bonds exploding to the upside. They hit, again, all-time high. We've got none other than, of course, gold, okay, exploding. And this is, again, it's just a 1 month daily comparison. Gold is outperforming the bonds, all right? These are both risk assets. People are buying them because they see risk, and yet we see the S&Ps exploding to the upside, okay? Extreme risk still prevalent out there. However, many people are going to look at things like the volatility index, the VIX. It's as dead can be. All right. I don't think it's displaying any degree of risk. The VIX goes off. It's literally like a fire alarm. It goes off, okay, after everybody's already seeing the smoke and is like, it's getting a little warm in here. Isn't it getting warm? That's when they see the volatility, or the volatility futures right now moving. Okay. There is huge capital moving towards the bond market. They're moving into the gold. All right. The fact that we rallied over here, possibly fueled by a little bit of a short squeeze, neither here nor there. The move that I'm discussing and the volatility that is likely prevalent in the S&Ps, this could take weeks and months to kind of play out. Nevertheless, okay, blank the chart here, go back to the S&Ps and just give you a little broader look in the S&Ps. Make no two ways about it. I will myself, and this is a duration stance that I'm taking. What a duration stance means months, okay? Means even years out there. Duration, there's no way that in the S&Ps right now that downside risk is worth being long the market, okay? So when I look at this marketplace, and again, I'm looking at 10 years right now. Why did I go into a 10-year again? Because it's kind of awe-inspiring to see how far we've moved, not to mention how far we've moved up in just a short period of time over here. Again, just a few months ago, back in February, we were facing 1,800. Nevertheless, the fact that you've got gold, okay, at multiple year highs right now, you've actually got the bonds at all-time highs. Their risk, okay, at the same time, you look at something like the S&Ps, and it's just a very simple argument that I've made time and time again. Tell me there's a wild number to the upside in here. What are we going to hit? We're going to hit 2,200? That's only plus 100. Let's get crazy. Let's say that the S&Ps can get all the way to 2,300. Okay? So what's the upside? It's about 200 points in the S&Ps, and I think that that's a fairly bullish number. But, okay, have to put it in the back of your mind. What's the downside risk? What are you thinking over here? 1,600, 1,400? It's insane. The risk, okay, is drastically larger to the downside. So if we put this in here is, all right, so you got 400 points of risk to the downside over there. Again, we're at 2,100. Now, 400 points to the downside doesn't sound like a whole lot. We were just 300 points lower a couple of weeks ago. Yeah, it's February. It's still a couple of weeks ago. I think there's about 400 points of risk to the downside, 200 points to the upside. So if you're looking at a position right now and you're short, all right, it becomes a risk 200 to be able to make 400, which really breaks down to the lowest common denominator. It's risk 1 to be able to make 2. Okay, and I think that that's a fair assessment right now inside of the S&Ps. Nevertheless, take a look for yourself on this long weekend. You're going to be bored on the 4th of July, right? There's no good fireworks. Okay, the barbecues don't really kick off until, I don't know, 11:30. You got something to do on 4th of July morning now. take a look at some of the comparisons. Again, look at the bonds, look at the S&Ps, look at gold. Okay, and again, compare to the dollar as well. I think you'll agree there is still a risk of brewing in the markets. Thanks everybody for joining us here at TheoTrade. We'll be back live July 5th in the TheoTrade chat room. Have a great 4th of July weekend. Bye-bye.